Hello everyone, and welcome to our webinar on recent changes and clarifications post 50th GST Council meeting. This was the first GST Council meeting after the 6 years of GST passed. We recently celebrated 60th anniversary, and this council meeting literally came bearing gifts for all the industries except for online gaming. So today we'll discuss changes that have come in the council. We'll discuss the legislative changes that have been proposed, the clarificatory changes for which several circulars have also been issued yesterday, and other changes. Starting with the legislative changes is firstly, we'll be discussing about the ISG mechanism and cross-charge. There's one legislative change in this and one circular which has been issued yesterday on this issue. So we'll be discussing the issue in entirety of what the council had to say on both these issues. Firstly, the council in circular number 199 has said that ISG mechanism has been made optional. In the council minutes, they also said that they are proposing to make this provision mandatory, but that would happen prospectively. So for now, for past period, till the time any legislative change is made, the circular has clarified that even if for common services you have not undertaken ISG, you need not do so. And there was no miss from your end for that respect. However, going forward, as the council minute suggests, there would be a change in the law provisions of that, and then ISG would be mandatory. So just having a look when ISG would be mandatory, what are the different provisions between ISG and cross-charge? So ISG requires a separate registration. It requires the monthly distribution, which is mandatory in law. So each month, whatever services which you receive, you mandatory have to distribute. You cannot choose that I'll distribute once in 3 months or once in 6 months, even if it might be your loss, but the law mandates that you have to distribute such ITC monthly. There would be a basketing of services. And what do we mean by basketing of services? That under ISG, whenever this change comes, you'll have to basket that whether services are common to, let us say you have 5 registrations. So services are common to all the 5 registrations or for any one registration, or let us say 2 or 3 out of all those 5 registrations. So that basketing also would need to be done when the ISG scheme comes into force. The distribution would happen in proportion of turnover. So you cannot do that if, let us say, a particular turnover has already excess ITC, you distribute less ITC to it, as we are doing under cross-charge presently. That option would not be there. And there's a complication for RCM that can be paid only through a normal registration. So you would have to pay RCM under normal registration, transfer it to ISG, and the ISG would need to then distribute it to all the registrations. And when compared, cross-charge in that sense is very simple. And that is why I believe many companies till now also have been following cross-charge. Because number one, ITC on goods and services, including employee costs, is usually cross-charge, but then you also get ITC of goods. There's a flexibility in valuation because of Rule 28. The compliance is easier. You do not need a separate registration. You don't have any specific turnover or, let us say, frequency in which you necessarily have to distribute. And even for the RCM liability, you can discharge it directly in the registration and then cross-charge it to all units across. So in short, this legislative change which is there is that in future, ISG would be mandatory and the taxpayers would need to be prepared for this adaptation, because ISG, again, informing the vendors that you have to invoice at a separate registration, then making baskets, making a mechanism that all this needs to be done monthly, would require specific efforts at the taxpayer end, and they should, in that sense, be adaptive. So whenever the change comes in the law, it would not be on an immediate basis, but whenever the change comes, the taxpayer should be ready for this change. Now, a very close mechanism or a concept which is dealt with ISG is cross-charge, or as the circular 199 has referred to as, is internally generated services. And this was one of the major issues that across forums was raised by the industry or the consultants, that this is something on which the clarity has not been provided by the government. So 6 years have passed, there was a lot of confusion on this, and now they have provided this clarity, and very surprisingly for the industry, happily being surprised that they have after the 6 years wait was worth it, in that sense that they have given a very favorable clarification for the taxpayers. So just discussing of what circular number 199 has discussed for cross charge, and probably the circular would be referred or discussed at many places regularly. So the discussion or the points are: number one, they said that for common input services which are attributable to branch offices. So the circular has explained that there may be a head office, there may be branch office located across states, and the concept can be attributed to, let us say, cases wherein there are factory in different states, or let us say marketing offices which are providing services to factory, etc. So the concept can be replicated, but the circular basically states that if ITC on common services which are attributable to other units, you have an option to use ISG, but again, that is an option. You may also issue a cross-charge invoice to other locations, and that cross-charge is valid. And only one condition, and a very logical condition they have put, it's not a negative condition. The only condition that they put is you can only cross-charge if there are any services which are related to that location. So you cannot, be it under ISG or under cross-charge, you cannot distribute or you cannot cross-charge to a location wherein there was no correlation of any service. So let us say there are two manufacturing units, both are running completely independent, and they are not providing services, or let us say there's no support from one manufacturing unit to other. Just because this mechanism exists and there's the option or that you can choose any value, it does not mean that you can transfer credit from one location to another. And similarly, under head office, it cannot choose that services which are exclusively to A location, the ITC is transferred to B location. So that clarity they have provided, that services attributable or only when head office provides service to branch office, only then they'll be cross-charged, otherwise not. Then a second very valid question which has been in discussions is, what value can you avail? And Rule 28 proviso very clearly states that you can adopt any value. But even then, there were confusions during audit or with the clients, etc. That do you need to include salary, number one, was a big confusion. Then secondly, how the format is. If let us say the format is not proper, or if let us in the format you have mentioned 2 services and you have missed out 3. So would it mean that those 2 services would, those 3 services are not being cross-charged, and now after audit you'll need to cross-charge? Clarifying all these points also, they have said that even if a particular category of service, or let us say employee cost, is not mentioned in the breakup which is there in the invoice, or an extra which is there in the invoice value would still be deemed to be the OMB, and therefore you need not do anything. So one, they have said that as long as cross-charge is there, there's a miss in the format, there's a miss in the annexure, a particular category is not included, it's perfectly fine. You can still, there's a compliance, and that is fine. Again, a second very big clarification or very big doubt is because in the initial years, many companies did not undertake cross-charge. So there was a time, or let us say specifically 17, 18, 19, there was no clarity whether cross-charge was required. Or there might be some companies which have only done ISG and not done cross-charge. So for that, the question was whether nil value can be adopted. And the circular has said that yes, nil value can also be adopted. So in short, if you have not issued any invoice, and all the units are eligible for full ITC, that would also be a sufficient compliance of this cross-charge provision, because you actually could have adopted any value. You could have adopted 1 rupee also for cross-charge. So they say even if you have adopted 0 rupees, that is fine. Nil value would also be accepted. And last point, again, a very, very big dispute that was coming was in sectors wherein ITC is not fully available. So you have healthcare sector, the ruling of Columbia Asia was there, which initially came, which shake the industry, that specifically for exempted sectors, wherein full ITC was not available. Therein the question was, okay, for rest of the services, there would be GST input coming, and therefore cross-charge was revenue neutral. But employee cost, there's no GST input. So if that was to be included, it would have been a cost in the system. But the circular has said that you need not include any employee cost. Even if the recipient units are not eligible for ITC, you can very well take or proceed that without employee cost also. You can very well take and proceed that even without employee cost. You can cross-charge and there'll be no question on that. Herein, the legality of the second and third point, wherein they have said that the value can be deemed to be nil or employee cost is not mandatory. There's no solid legal backing which the circular has given that why this is legally correct. And circulars are meant to clarify the law. So it probably is the dangerous trend that is coming, that they have gone beyond the law and stated several clarifications which are not clearly coming from the law and not giving a legal reasoning also. And here the enforceability of circulars on the department. So circulars are not binding on the SSE, but they're still binding on the department. So that concept or that jurisprudence now comes to play, because all these are favorable circulars, and to that extent would go in the line for taxpayers that if department wishes to take another stand, they cannot legally, because the circular is there and it is binding on them. Yes, vis-a-vis the disputes or the litigation which are already in the appellate forum or show cause notice has been issued. So in a judicial capacity, yes, the circulars can be distinguished or ignored. But as an administrative capacity of the department cannot choose or pick and choose that the circular would not apply. So this is the first issue or the first circular dealing with cross-charge and ISC mechanism. Now coming back to the legislative changes, they have proposed 2 amendments in the rule. For the first amendment, it is more towards a prescription on the form. So we all know that a difference between GSTR 1 and GSTR 3B is considered as a self-assessed tax. There was an explanation inserted in section 7512, and it was considered as a self-assessed tax. The law even prescribed a rule stating that that would be an opportunity of being heard would be given therein. So let us say you are filing GSTR 1. Instead of 10 lakh, you added a 0 and 1 crore liability went. And in 3B, you wanted to declare the correct tax liability, you declared 10 lakh rupees. So the law states that 90 lakh difference, it is a self-assessed tax. You can recover even without giving show cause notice. Direct recovery proceedings would initiate. The department later, through a rule, introduced that no, direct recovery would not be there. There will be an opportunity being given to the assessee to explain this difference. And now that opportunity has come in form of DRC 01D, wherein they have said that, once B came, wherein they said that the form would be given asking that DRC 01B form was there, to asking for the difference. Now, if let us say that form is not there, so DRC 01D would be there for recovery. So that would be an order of recovery in case any satisfactory explanation is not coming from the assessee. Next, this is a new rule, or this is a new proposal from the GST Council side. Is 1 versus 3B, there's a statutory provision, self-assessed tax. Now, for any difference in GSTR 2B and 3B, right now what they can do is, if they are not satisfied, they can scrutinize the return, they can issue A70 10, they can issue DRC 01A or show cause notice in DRC 01. But now what they propose is that they would issue a new form. So they'll be introducing a rule 88D, and they'll be issuing a new form DRC 01C, wherein the difference would be when in excess of a specified percentage, they'll ask the taxpayer why this difference is. And if, let us say, the reply is not submitted or if it is not satisfactory, the rule under which they have brought in this provision, that would allow them that the GSTR 1 for the subsequent month may be blocked. So the assessee, if let us say he cannot just ignore the notice or say that, okay, you issue me A70 10 or you issue me DRC 01 show cause notice, and then I'll reply with my reasons. If the reply is not submitted or if it is not satisfactory, they can block your GSTR 1. And we all know that in present time, if the GSTR 1 is blocked, your business effectively gets hampered because the recipient would not be getting the credit. You cannot file your GSTR 3B. So the entire chain of filing of return gets blocked because of this. So again, a very critical amendment or proposal from the GST Council side, that the difference in 2B and 3B would also need to be explained. Thankfully enough, the news report are suggesting that it would not be a minor difference, let us say a 1 lakh rupees difference, and this would be blocked. They would be having a prescribed limit of, let us say, 20% more and more than 25 lakh. So if the difference was substantial, only then would they come and undertake this action or revoke this provision. Otherwise, they may not propose under that, or otherwise they may not go into that. Moving forward to the next, and again, a very awaited provision discussed a lot in the 6th year anniversary at various forums was constitution of GSTAT. So in this Finance Bill, Finance Act, they approved the provisions of GSTAT, but still several the action steps of that constitutional were missing for constitution of GSTAT. So now they in this council meeting, they have said that the amended provisions will be effective from August 1. The rules of appointment would be notified and the state benches would be constituted in a phased manner. So in the press conference after the meeting, there were discussions that state may come up with 1, 2, and even till 5 benches. So what initially would be proposed is in whichever areas of the state, there is a high court bench. In that areas to begin with, there would be a GSTAT, and later on, when the members increase and when the provisions are satisfied, after that, they would then increase the number of benches. And to that effect, the realistic figure which was discussed in the press conference was that in next 4 to 6 months, we can see a up and running GSTAT. While that seems to be a difficult idea because the members needs to be there, the infrastructure needs to be created. So a lot of work still needs to be done. But in a ray of hope, the Revenue Secretary mentioned that hopefully in the next 6 months, there would be a GSTAT which would be formed. Just a thought and an important point to touch upon here is that basics, the rectification of defect order and also circular issued post that, the appeal would have to be filed once the GSTAT is functional. So in the intermediate period, the time period of filing appeal is not expiring. There's an automatic extension to that extent. However, unfortunately, what is happening is that a lot of recovery is being done under once the order is being passed that the GST Council, the order is being passed by the Commissioner Appeals. After that, a lot of recovery proceedings are being initiated by the department. Several states also have issued a circular. High courts are time again saying that you cannot recover at max. There may be a 20% free deposit, etc. But yes, there is the I'll say action being taken from the state. So the hopefully that on that point also a circular is issued. Or if let us in the next 6 months the GST Council is formed, so the appeals would need to be filed thereafter. Next is the issue of online gaming, and which has been discussed a lot after the GST Council meeting. On this, the GST Council, what they did was they said that they would bring in casinos, online gaming, and horse racing at par with betting. So tax would be there at 28% on the full chips or on the full bet value. What this does is that we all know recently the decision of Gamescraft came. It made that distinction between game of skill and game of chance. That distinction would no longer be there. So effectively, on whatever the betting amount is or whatever the amount that is being paid by the player, in this case, the entire amount would be taxed. Here, another, so they would probably make a legislative amendment in this. Another interesting concept is the Revenue Secretary touched upon in his press conference was that what they may do is for foreign online gaming companies, they may bring in another provision or a concept of TCS that when the banks are making payment to them for online gaming, they deduct this 28% and then remit the balance amount to them. So these provisions would also be very, I'll say, interesting to note that how the government implements it, but government seems to be very determined to tax this amount. And in a subsequent interview, the CBIC chairman also indicated that there is the social angle to levying this 28% and not distinguishing between game of skill and game of chance. But having said so, the valuation mechanism may be challenged because even though the service which these online gaming companies provide is only a facilitation, still the entire amount is being charged. And also for casinos and online gaming, there's a distinction I'll discuss in the example just now. But yeah, even on that basis, there may be a challenge on the provision that how can we challenge the computer. So just to understand this example of how this would be challenged or how this would impact the industry. So let us say two players in a bet, they place a bet of 100 rupees each. So what used to happen till now is 20 rupee commission of the online gaming company. On this 20 rupees, to 18% GST was there, that was paid. And the balance amount was prize money. So whosoever out of these two persons won the money, he used to get 180 rupees out of that. But now what would happen is with this 28% GST coming on 200, 56 rupees would reduce. So considering that the commission remains same, the prize money would reduce significantly from 180 rupees to 124. So for a person or for an individual to engage in this online gaming with the expectation that he may win this amount, that expectation or that incentive would be much lower. Yes, the entertainment value would still remain, and to that extent, 28% GST, if he is willing to pay, that's fine. But otherwise, for these online gaming, this is a big hit. There might also be a silver lining to this entire scenario. While so much negative has been spoken about it, there might also be a silver lining that now at least all these disputes for future would set to a rest. Because this high show cause notice, department disputing, they probably thinking of a retrospective amendment, those all things would have actually shifted the focus from business to tax. Now, whatever tax be the case, now the companies would know that this is the GST amount or this is the TDS amount that needs to be deducted. And basis that if the business is viable, they'll continue. And the individuals also, if they are finding value in that, they'll continue paying. Moving on to the other legislative minor changes. One is that for Tran 1, Tran 2, after Philco, this entire manual e-filing of Tran 1, Tran 2 was opened. For after manual filing, there was an order which was to be passed, allowing transitional credit or denying transitional credit. If, let us say, then order was there denying transitional credit and the taxpayer was aggrieved, he should have filed an appeal. The manner of appeal filing, because there was no online provision, they allowed a manual filing. However, what I believe GST Council missed was that in many cases, even the transitional credit has not been received in the taxpayer's account. So manual order was passed, but there was no proper system that manual order resulted in getting of transitional credit in all cases. So that part could also have been clarified by the council, say that you can take a credit in GSTR 3B by this reason. But to that extent, clarification was missing. And they have also proposed a new provision for place of supply when the goods would be supplied to a unregistered person. So you can look forward to an amendment which would come in Section 10 of the IGST Act, probably clarifying things in that regard, that whether CGST and SGST would be leviable in this case, or if an address is available, whether IGST should be levied. But we'll have to see what amendment is there in order to see. Moving forward to other clarificatory changes which have come. The next, I'll say another important or a favorable circular which has come is GST implications on warranty transactions. And this issue has recently come to limelight because of this Tata Supreme Court judgment also. So I'll explain the transaction. I'll then briefly touch upon of what Tata said in the Supreme Court, and then what circular has stated and whether that's right or not. So usually what happens is manufacturers selling goods to customer either directly or through a dealer network, but the warranty liability is usually on the manufacturer. So consumer he can enforce the warranty liabilities on manufacturer. However, because the distributor network is widespread, they undertake the repairing activity. So if let us say there is an automobile which has been sold, like in Tata, and it is under warranty and there is a defect, he goes to a distributor or a dealer, he undertakes repairing activity. He does not charge any consideration from the customer. Instead, he charges a consideration or collects money from the manufacturer. And there may be different ways how he collects the money. So taking a simple example, he issues a tax invoice and he receives money. So on that tax invoice, that is one way of which the consideration can flow or may flow. In Tata, it was not through a tax invoice, but through a credit note. But Tata Supreme Court held that even this transaction, wherein this money is flowing through credit notes, that is also sale only in that at the time of sale tax law, and accordingly, sale tax would be levied. Applying it under GST, the Tata judgment would mean that in this particular case, the distributor is receiving a tax invoice, and those tax invoices being raised, they attract GST. So now we'll come to what circular has said, but just briefly explaining what Tata judgment said, it was that between distributor and manufacturer, when there is an exchange of consideration, it attracts GST. and rightly so. Circular touched upon two aspects. Firstly, it touched upon the fact that when the manufacturer or distributor, if they are providing the repairing service of their discharging their warranty obligations to customer, so they also assume that there may be cases wherein distributor is undertaking warranty obligations and he is not recovering any amount from the customer or from the manufacturer. So therein they said that no GST is payable because no consideration is involved, and because this was an obligation and the price gets included in the initial price, there is no reversal for ITC. I'll bring in an interesting point here in the sense of, just one second. Yeah, an interesting point can be that there may be warranty obligations even in cases for exempt goods which were sold prior to GST. So just taking an example, let us say tractors, they were exempt from excise duty, but under GST, they do attract GST at the rate of 12%. So the logic that the price has suffered tax may not hold true for such cases for exempted goods which are sold prior to GST and the warranty obligation being discharged post GST. So to that extent, another para of the circular becomes very, very relevant. They say that whatever these services or supplies are, they are not attributable to any exempt supplies per se under GST law. So under GST, we believe that even though prior to GST, there might be exempt supplies, post GST, there will be no ITC reverse. Now moving to the other parts wherein, and again, the second important part, which was dealt by Tata Supreme Court judgment, wherein the circular has dealt that when the distributor issues a tax invoice on the manufacturer, therein there would be a supply from the distributor to manufacturer. And also they say that GST is payable, but ITC would also be eligible to the manufacturer. So they have clarified that in this case, yes, tax is payable as was held by Tata, but they have also said that ITC would be eligible to the manufacturer because he received these goods or services to discharge his warranty obligations. Now coming to the third part of the circular, which was not fully catered to by the Tata ruling, but which has been catered by the circular and might be followed by some companies, and which is again favorable to the taxpayers. So in this part, they held that even though the distributor undertook repairing activity, they did not issue a tax invoice on the manufacturer for the value of goods. They either sought a replacement or the manufacturer issue a credit note to them. So manufacturer, he must have initially sold the parts to them, let us say of rupees 100. Subsequently, either the manufacturer for 100 parts, the distributor used 40 parts under warranty obligation. So instead of raising a tax invoice for 40 on the manufacturer, the circular deals with a case wherein the distributor got those 40 parts back on the manufacturer, or a case wherein the distributor sought a replacement of 40 parts, or wherein the manufacturer issued a credit note showing these 40 parts as sales return. So in this case, although there is no GST or no ITC reversal, and credit note can be issued for reducing liability. In our view, this part of the circular is not legally correct. The reason is that once the distributor uses his parts, getting free parts from manufacturer is actually in the nature of barter and should be taxed at both ends, from the manufacturer also and from the distributor also. And similarly, if let us say credit note is being issued, there is no sales return which is happening on account of which credit note can be issued. But then again, it is, I think after the 6th anniversary, that was a time of favorable surplus. So this part also is favorable to the SSE and can be relied by the SSEs in order to state that there is no GST liability or no ITC reversal. Coming back, a last point which was dealt by the circular was vis-a-vis extended warranty. So therein they said that if let us say originally at the time of purchase of goods only the customer buys extended warranty, then it would be a composite supply and GST as applicable on principal goods would be applicable. And if it is after the original supply, applicable GST rate on extended warranty which would be 18% would be payable. Now, this part is unfavorable and would need to be analyzed in further detail, whether extended warranty can be said to be an composite supply or not. But at least now for auto sector, because they attract a higher GST rate and also compensation cess, extended warranty for vehicles which are sold at the time, extended warranty sold at the time of sale of vehicles would now need to be analyzed and would become more expensive. So customers might prefer that, even though on next day they might decide to buy extended warranty. Moving forward to the next clarification that was issued, again a very important clarification. Why important? Because the taxpayers were being harassed, I'll say, for this reason on which there was no logical reasoning. So under GST law, under one of the SSCs, there is the SSC of holding of shares by a subsidiary, by parent company for subsidiary company. And basis that SSC, the GST department was demanding GST on these from parent companies wherein they were only holding shares, not undertaking any activity or providing any services. So the circular rightly has clarified that their securities are neither goods or services, and no GST is payable because there is no activity and no supply in this case. So a straightforward clarification that no GST would be payable in such cases. Yes, but still there are transactions which are being investigated by DGTI or the local authorities. One of them is corporate guarantee. So recently the newspapers also reported that on the issue of corporate guarantee or personal guarantee by directors, the DGI has started issuing show cause notice. So that issue remained open. And second, another very related issue to that would be of valuation. So while for internally generated services, they have clarified that you can take any value, ITC would be available, even nil value can be accepted. So for whether for corporate guarantee also the same concept can be applied. Can you say that nil, because my subsidiary company would be getting full ITC? Can I say that that nil value concept for internally generated services would apply here also? Because the provision is same. Rule 28 is the same. And therefore, even if I did not discharge anything, that would be considered as a complete discharge. So those questions would then come and have not been clarified by this. So services by directors, again a favorable clarification which has come. They have said that only services which are provided in capacity of a director would be under RCM, and balance services would be under forward charge, and therefore directors may require registration. So just take an example. So let us say a director, he rents a property in personal capacity. He is, let us say, or providing any other services. He is providing a brand usage, allowing a brand usage. In the last slide, we saw he's providing corporate guarantee. So for all these services, they would be chargeable under FCM. However, in capacity of a director, so sitting fee, that would remain under us. But if director is an employee, so even any salary paid to him or any sitting fee or compensation paid to him would not attract any tax, because that would be covered under Schedule 3. Just a point to note here, even though in the GST Council minutes, they took an example of renting service. However, renting of residential dwelling by a director to a company would still remain under RCM. So that part would not change because it is covered by some other entry of RCM and not by services provided by directors. However, commercial property or any other services, that would no longer be under RCM. Also, for many other clarifications, while the council stated that things would remain as is, on this also, if they could have clarified that, it would have been helpful. Because in many cases, or because the disputes were being raised under the service tax, many companies decided to pay tax under RCM as corporates. So now what should not happen is the department going to the directors and saying you did not discharge under RCM and therefore we'll recover this amount from you, or disallowing ITC to the company saying that this was never payable and you have paid incorrectly. But hopefully in that extent, either a further clarification is issued or the past jurisprudence comes to the savior. Because under past law also there have been jurisprudence to support this, that even if, let us say, liability was to be discharged under forward charge but was wrongly discharged by another person under reverse charge, no double recovery can be done. And similarly, ITC cannot be denied. Moving forward, the clarifications which they have provided for refund. So first clarification which they have said is that while computing input stage refund, and firstly, let us understand why this clarification came. For input stage refund, when you are determining the value of export turnover, that is lower of FOB value of goods and value in tax supply, whichever is lower. That was an amendment which came recently. Now they have said that the same logic, because in the numerator, you are reducing your value, the same value you reduce in the denominator also. You don't say that numerator will take a reduced value and for denominator full value. So this clarification they have brought in. Second, because ITC has eligible basis GSTAT 2B, now they have said that the refund would also be based refund when you are computing or when you are applying. Only that refund of ITC would be there, which is there in GSTAT 2B, which again is more logical. This is the most substantive change which they have brought in through a circular. So Rule 96 states that if, let us say, you have exported services and you did not get any consideration for an year, you need to pay GST. Or if you have made exports under LUT, but you did not, issued an invoice, but the export did not happen within 3 months, you need to pay GST. And both these GST need to be paid with interest. Subsequently, if the goods get exported or the consideration is realized, there was no provision of what would happen. So the circular says that if, let us say, after 3 months, the goods get exported, and after 1 year, the services consideration is realized, you would get the refund. But interest, they say no refund of interest would be. So there was a representation that refund of interest also be allowed. They said, no, that will not allow. But yes, export of goods and realization of services, on that account, you will be eligible for getting a refund. They also prescribe the manner of how this refund is to be applied. But yeah, that was also. Moving forward to other clarifications that they have brought in. So again, there is a concept or there is a logical reasoning of why they brought in this clarification. Way back, what the law states is for the credit, it can be utilized in a staggered manner. So you can staggered manner in the sense that you firstly have to exhaust your IGST, then you CGST and XGST you exhaust correspondingly, but only after the IGST credit balance is zero. So the question was that once Section 50 was amended to say interest is payable only if the credit is utilized, and if it is not utilized, interest is not payable. How do you compute that credit is to be utilized? So they have said that for IGST, you see the balance of all three, because otherwise IGST balance would always be zero independently. So you see the total of IGST, CGST, and SGST, and if the total is more than the credit wrongly utilized, then no interest would be payable. But for compensation cess, because that cannot be utilized for IGST, the logic would not apply. But yes, if you see in that sense, the same logic would also apply. So if you have wrongly availed SGST and there's an IGST balance, you can see a total balance rather than only SGST balance. So yeah, the logic basically is how or when the utilization is based and not otherwise. Another clarification which was there, which the industry, even though it was following, was that whatever food and beverages are there served in the cinema hall, there is a service element in it, and therefore it would be taxable at 5%. But if at the time of issuing of ticket only, there has been, so when you are booking tickets, therein only you choose that I'll need this food and beverages, then it would be a composite supply. And in that case, you would be attracting a higher rate of 18%, which is applicable on cinema services. Some minor more clarifications which was there. Circular 183 was issued, wherein they said that if there is a mismatch and any ITC is not coming in your GSTAT 2A, that you take a declaration from the vendor, or let us say from the CA, stating that he has paid full tax, and accordingly ITC would be allowed. Now this circular which was issued initially, circular number 183, that was issued only for the first 2 years, 17, 18, 18, 19. Now circular 193 has said that it would also apply to subsequent years till December 21. However, so you can take a certificate that the balance is not being shown in your GSTAT 2A, tax has been paid, you'll be allowed ITC. However, ITC would not be allowed in violation of Rule 36. So they have stated an example in the circular that whatever limits, 20%, 10%, 5% was there, within that limit only you can get a certificate. Beyond that, if you get a certificate, that would not be considered or would be of any use. Then they said that e-invoice needs to be generated for government companies also, for supplies made to government companies. For ECO and OIDR, they have said that if you are supplying to an unregistered person, you can only mention state of the recipient rather than the full address. And for registration, while there have been no proposal that has been issued, there were suggestions that they can verify even when the taxpayer is not present. So presently, they can undertake verification only when the taxpayer is present. Going forward, they can do so even without. Other changes which were proposed were for compensation cess on SUVs. Earlier, 4 conditions were need to be satisfied. Now only 3 have to be satisfied: length, engine capacity, and ground clearance. So a condition that they should popularly be known as SUV has been removed. And they have also clarified, they would also be clarifying that the ground clearance should be seen in an unladen stage. Now, a very, I'll say, interesting question here is, if these 3 conditions are satisfied by a car which is definitely known as a sedan, whether that would also attract 22% cess or not. It seems that through the clarification that it would attract. But if you see the interview of the CBIC chairman, it seems that right now a decision has not been taken on that. And the decision is pending before the fitment committee. So they only wanted to remove the doubt between MUVs and such larger cars which are not technically known as SUVs, but they did not want to presently cover sedans under this 22% category. So that we need to see how this amendment comes into the notification. Then another change is that GTA, for opting for forward charge, he needs to file an annual declaration. They have said you need not file an annual declaration, you can file one time. And declaration would only be there if you are changing from FCM to RCM. But if you remain under forward charge, every year GTA need not file a declaration. And here there is also one takeaway for, I'll say, taxpayers who are receiving the services of GTA. So usually what happens is the, let us say the GTA, he starts charging GST on invoice, and the taxpayers say that, okay, he's charging, so he must have made his compliance. But to that extent, because it is the service is also simultaneously covered under RCM, you should take a copy of this annual declaration which is filed one time. So whatsoever declaration is there, so if let us say he provides a declaration, then you can shift to forward charge. Next, if you want to shift to an RCM, then you again seek a declaration from him that he has filed. But yes, that I'll say a check can be placed by the companies in this. Then moving forward, there have been certain amendments for tobacco products also, wherein RSP was not applicable. Bulk products, they have said cess would be at ad valorem. They are moving to capacity-based taxation and compensation scheme. Restriction of machine procedure is there, and they'll not allow exports on payment of IGST. For annual returns, for last year, whatever relaxations were there, they have carried it forward. So many relaxations have been there in the forms that you need not fill particular columns. Those relaxations have been extended to this year. Lastly, for amnesty schemes which are there, the due date was June 30th. They have been extended till June 31st. Thank you, everyone. Thank you so much for attending this webinar. Have a nice day.